Hello Ape Nation, hello Ape World, welcome now Stock Trades. In this video, we're going to go ahead and talk about the probability of a recession. I went ahead and joined the ape fight because I realized a lot of the ape investors started trading in 2020. They're relatively new to the market and unfortunately haven't seen downswings, which is a part of a normal market cycle. So without further ado, I want us to basically get us situated and started so you'll learn all these data. And by the time you finish this video, you're going to be more informed than 95% of the population in the United States. And that's saying something. Okay. So if you go ahead and take a look at the Conference Board Leading Economic Index, you can go ahead and Google them. They're a leading economic index to basically tell you when a recession is about to happen. So I'm going to go ahead and remove myself from the image. And as you can see, we've been trickling down here since the really overall stimulus of the economy. And now we're contracting down below once we reach this kind of black threshold. Unfortunately, it does not look good for the economy. And we don't know if this is going to be a short-lived recession, but usually based from this historic range, that last time we had a Federal Reserve increasing this much was back in the 80s, which, right around here, the Paul Volcker area. So, when inflation was going rampant, right when the economy was literally increasing like crazy. So I believe personally, we are in the beginning of some extreme pain. If you go ahead and take a look at the composite recession model, you can see that we just crossed over 50%. Whenever we do that, it is definitely indicative that we are, the trigger has been pulled. We are about to engage into a recession. Now, bringing my face back onto here, if we go ahead and take this recession model and we let it basically declare a signal, which is what we've experienced in August 31st, we can see that in the past historical data, if we take it average and use statistical modeling, within 3 to 12 months, we are going to be experiencing a tumultuous negative stock market. The problem is it's not just one data basically tells you this is how the market is going to be. If that was the case, you would unfortunately, everyone would be billionaires, right? It just doesn't work that way. I believe one Chamath Palihapitiya said a really nice word that I like. You get a mosaic of data. And it's up to you as the investor to make sense of that data to formulate your own investment thesis. And my job here is to help you retail investors see exactly multiple sides of the argument, because that's what a seasoned, intelligent investor would do. So if you look at the tactical composite trend model, you can see here we are experiencing a recession warning, but we are getting mixed signals. We are still, in some cases, in the bull case, which is why a lot of smart money and dumb money, if you've looked at my graphs before, a lot of hedge funds, they're still going in and purchasing stocks, most likely below their intrinsic value. So if you go to the LEI signal, which is one of the most dominating signals you can use when going into a recession, we did signal on July 29 that we are about flipping the switch for a recession. And usually when this happens, you can look at the time frames here, 69, 73, 1980, 81, and most likely the ones that you've heard of, 2000 and 2007 and 2020. We essentially get into a recession right after. And the question is, how long is it going to take for us to get into a recession? Are they waiting until after the November elections? Or, the midterm elections, or are they waiting maybe until after next in 2024 for the presidential elections? We'll talk about it. So a great way, and we spoke about this in our bi-monthly meeting here at our All Stock Alerts and Mastering Stock Market course, we talked about how you can use the 2-year Treasury yield to essentially help you determine where the federal funds rate is going to be, because the federal funds rate is essentially the rate at which the FOMC declares an interest rate hike. And most likely if you're watching this video, you probably understand what a FOMC federal rate hike is. And what I'm telling you is you could use the 2-year to essentially estimate where the FOMC is going to rate hike, because the bond market is bigger than the stock market, and it's a great predictor of the stock market. And if you were to go ahead and just analyze this specific graph on September 16 before the FOMC meeting, which was, September 21, 22, you could basically determine that the market actually was pricing in a 100 basis point hike, but actually it came out worse than that. And I'm going to explain why. So as soon as the federal Chairman Jerome Powell talked about and showed his dot plots, the 2-year Treasury essentially increased. And it got to a point where it became so high that literally at the 1 year or the 6 months became 4% as well a couple of days after, which means that you are guaranteed to make 4% in 6 months on your money or a year or whatever you want to hold it for, which is guaranteed from the U.S. economy, which is why so many people now are pulling money out of the market. And people that are waiting are going to wait longer now to put their money back into the market, okay? Why? Because if I'm going to be on average on an index given 8% on average versus a guaranteed 4.2%, the decision is very, quite frankly, simple. So I hope you understand the bond market because it will help you to, be better than majority of the competitive day traders that you are all fighting against. So here is the table 1 of economic projections. If you go ahead, just, briefly go ahead and go down here from the federal funds rate. It went from 4.4 all the way up to 4.6. Ladies and gentlemen, for 2023, this is a lot. This is a big increase. And if you look at where it was before, he literally increased it from the June projections, by 1. Literally, that's a big deal. And that's why the market has been tumultuous, and it's going to get even more pain. It's going to be more pain. Another thing here, if you take the 10-year Treasury yield subtracted from the federal funds rate, you can see that whenever it dips down on the inversion yield, you get an inverted yield curve when at 0. It's basically telling you that the bond market is predicting something. And we're starting to get to that inversion. And the question is, and we asked our bi-monthly members, is that, well, does billionaires and hedge funds know when the market is going to crash before the market crashes? Of course they do. In fact, Warren Buffett was one of those people back when Lehman Brothers collapsed. He was actually he got a call from Hank Paulson, the former Secretary of Treasury under George W. Bush's presidency, and he was asked if he could buy Lehman to get those troubled assets out so the economy doesn't collapse. Warren Buffett said no, but he knew with this privileged information to essentially using intrinsic value and analyzing annual 10K reports, he was able to make billions of dollars off of the pain and suffering of so many folks. So now we're in a position, if you go ahead and look at the 10-year and also the 30-year mortgage, we're approaching 30-year mortgages that have expanded and surpassed the 2008 great financial crisis. But unfortunately, you're going to see a lot of people make similarities within the financial crisis. And I'm going to explain to you what are these similarities, because there isn't. So if you look here, and I'm going to remove myself on the x-axis, you can see in 2008, you can see an inversion here where the green line is the owner's equity, which is how much money people have in their houses. And the blue line here is home mortgages. So you can see literally if the home mortgages is blue like water, you can see the owners of these home mortgages were underwater. And you could have easily seen this inversion, which is why Dr. Michael Burry, the Big Short, was able to capitalize on this, right? Right now, as you can see, a lot of homeowners have a lot of equity in their home. So this is not looking like a great financial crisis that you see in real estate. We may see a small correction, maybe a crash in markets that are, let's say, increased a lot, like, for example, Phoenix or maybe Florida or Texas. But we are not seeing something like we did in 2008, where we had the home mortgage over the owner's equity. We're actually far from that, all right? So I hope that sorts this whole dilemma regarding the great financial crisis, right? But now, if you look at personal savings, when the Federal Reserve injected so much money into the economy, the stock market did incredibly well. The problem is now a lot of this money is being sucked out. And with inflation running high, personal savings is going down. If you take the personal savings, which is going down, interest rates are going up, and the risk of a recession is going up, how do you think this is going to impact the AMC stock? Now, many people, again, are saying that this is going to be like the great financial crisis back in 2008. But if you look at the S&P Financials forward earnings per share, essentially the analyst average forecast, you can see here that we are no near the levels that we are in 2008 and not even actually 2020. So I don't think this is going to be another great financial crisis. It does seem like a recession. The question is it going to be an extended one or short-lived? And the answer lies within the bond market. So from there, which is exactly why a lot of money is being inflowed now in the bond market. But what I'm seeing now is something quite interesting. In fact, many investors are actually pulling out in just straight cash, waiting for the inevitable recession. So you have to ask yourself, is AMC free cash flow positive? When is it going to become free cash flow positive? Can they satisfy their debt with an increasing interest rate? And are shorts going to eventually basically win this battle? And how do you think the ape investors can ultimately win? I myself am holding ape and AMC, and a lot of our own investors has sold ape because it is going to be used as a dilution factor, right? Because that's how they're going to raise money in order to keep essentially AMC afloat. So comment down below what you guys think with all this economic data. There was a lot discussed, and that's all I have for you. And for all the individuals that are interested within our platform, we have been featured on Bloomberg, NASDAQ, and Yahoo Finance. You can find more information about us in the link down below. That's all I have for you folks. I'll see you on the next one.